Hello, and welcome everyone to another terrific webinar brought to you by Leighton. My name is Judy Olivenza, Learning and Development Program Manager here at Leighton USA, and I'm joined by Ilham Ben Laribia. We will be moderators for this online event. We are very thankful you've joined us for today's webinar, Nexus and Sourcing Planning, Year-End Review for Your Business and Clients. Our dynamic duo presenters today are Brian S., tax attorney and Leighton's state and local tax practice lead, and Seth Rabe, tax attorney and SALT manager here at Leighton USA. Prior to starting this webinar, we are just going to cover a few housekeeping items, technical checks to ensure a great learning event. If you're experiencing any technical issues, please let me know via chat message by clicking on the chat icon in the top right corner of your screen. You may also refer to the quick reference guide document that can be accessed in the handout section. The questions pane is also where you can submit any questions or comments to our presenters. This webinar qualifies for 1 CPE credit. This credit will be available to you within 24 business hours, and you'll be notified at the email address that you used to register for the webinar when the credit is issued. To earn credit for today's webinar, you must stay logged in for a minimum of 50 minutes and answer polling questions. There will be 5 polling questions today, but to earn credit, you must answer at least 3. If you happen to lose connectivity to the session or need to log out and back in, the webinar software will keep track of your time. Please be informed that today's webinar will be recorded, and we recommend that you download today's presentation materials and learning objectives, which can be found in the handout section of the webinar. And now, without further ado, I turn things over to Brian and Seth for the main event. So take it away, gentlemen.
Thanks, Judy. That was well done. Did you have that memorized?
No. Some of it.
Thanks for setting, thanks for setting that up, and welcome everybody to this webinar. Admittedly, you know, it's kind of a mouthful. Nexus and sourcing planning. We're usually better at alliteration or some rhyming, so forgive us for that. But we're happy to have you here. Nonetheless, as you'll see through these slides, I'm pretty excited about the holiday season. I'm excited about Thanksgiving. I've got my Thanksgiving dinner attire on. I've got a pumpkin coffee mug ready, so I'm ready for this. So anyway, getting into it, let's see. Quick introductions. As Judy said, my name is Brian S. I lead our state and local tax division here at Leighton. Have been here for 2.5 years. Time flies when you're having fun. Prior to that, spent some time at Big 4 and top 10 CPA firms, but happy to be here and happy to be talking with you. Seth?
Thank you, Brian. Seth Rabe. Prior to my experience here, I've worked at the Big 4 as well as other mid-tier accounting firms. I have about 20 plus years with SALT experience, pretty much everything SALT related. And I have a law degree with an LLM in tax, and I'm licensed in New York.
Awesome. And Seth is in New York. I'm in Arizona, so it's hard to get a little further away than we are. But just to make sure the chat's working, we'd love for everybody to chime in where you're listening from. How's your weather? Are you excited about Thanksgiving? All that stuff. Please feel free to use the chat. We will look for your messages and try to respond to them as we go through this presentation. Some quick information about Leighton before we get going too far into it. Leighton internationally is in about 18 or 19 different countries. We just opened up an office in Greece, trying to figure out how to go for that ribbon cutting ceremony. But we have been in business for about 30 years. I know it says 25 plus there. I think we're on year 28. So we're very well established across the country. Leighton US has been set up for 8 or so years now. Offices in Boston and San Francisco. Plans to open them up in Houston in the coming months, and Tampa, trying to get one here in Phoenix. So we're growing, and of course, like a lot of people on this call, probably have a lot of remote workers. So we have people in Chicago and almost everywhere that you can think of. So that's about Leighton. the other thing is, we were talking a lot today about state and local taxes. That is one thing that we do. We also handle commercial real estate, energy efficiency, and Layton's true calling card is research and development tax credit. The fun fact there is we are the worldwide provider, #1 provider of the R&D tax credit. So any questions you have about that, that is something that that our team could answer and help you get. So that's Layton as a whole. All right, now we're ready to get into the meat of it, and that's dad pun #1, talking about turkey meat. The agenda for today, nothing surprising here. Recap of state and local tax, what all of it involves. We'll dive into sales tax things. We'll dive into income and business tax, as I like to describe them, and then just some final points to keep in mind. So, Judy said we have 5 polling questions today. Let's get you #1. We made sure to put a lot in there so that you have the opportunity to answer them. 2 parts to this question. The part that you really need to pay attention to is the in parentheses part. What is your level of knowledge in Nexus and sourcing for sales and income tax? I like to spice it up, guys. We're here to talk about taxes and tax law, so try to make it fun. If you enjoy my dad humor, I appreciate you. If not, bear with me. So anyway, Judy.
Yeah.
I'm assuming the poll is open. Okay.
Yep, the polling question is up. So question is, what does your Thanksgiving plate look like? But of course, the actual question is, what is your level of knowledge in Nexus and sourcing for sales and income taxes? So we'll give everyone a couple of seconds to submit their response. And looks like we've got...
Seth, what's your answer, by the way? Are you going back for seconds and thirds like I am?
Oh, I thought you meant my level of Nexus knowledge.
No, I'm more worried about Thanksgiving for you. I know your level of experience.
I'll eat well.
You'll eat well. Good answer.
I'm in the same boat. All right, we're going to close the poll in 3, 2, and 1. Thanks, everyone.
Awesome. And then, Judy, are the polling results up on the screen?
Yes. Well, they just disappeared, but it looks like the majority of the people. It's definitely a mixed response.
Okay. Always good. Mixed bag. All right. So the first agenda item, like we talked about, was state and local tax. And the reason we put this back in here is to make sure that everybody's aware of all the things that state and local tax means, right? Sometimes we say SALT and someone says, oh, we're filing our income taxes in certain states. And sometimes we say SALT and they say, oh, we're collecting sales tax and we're good. And really there's a lot more to it. So just a quick rundown here of everything that SALT covers. So, it helps you prepare for due diligence, mergers, acquisitions. The SALT, sales tax, income tax planning, registrations, all that stuff is a huge talking point, an item that comes up when any of these things happen. So making sure that you're taking care of your SALT activities is really going to prepare you for any of those mergers, acquisitions, or sales. We like to say that having a full plate, just trying to keep these puns going, a full plate of SALT really ensures that you have the entire blueprint of your activities throughout the country. And so just making sure you're aware of what you're doing, what the states say the rules are for the type of activities that your business operates in, gives you a nice blueprint of what to do about state and local taxes as a whole. And then having that blueprint kind of helps you become quote unquote audit proof. I make sure to put the quotes in there because, as a lot of you guys probably know, some of these audits are done at random, and the bigger the business is, the more likely you are to be audited. So no surprise there. But the point is, if you have a good understanding of your SALT landscape and you have that blueprint, you'll be like a high school kid in a fight, and you'll say, "Come at me." You'll be really excited to know that you don't have to worry about any audit letters that you get. So that's an important part. And then finally, just peace of mind, right? So if you have a strategy in place, whether that's a CPA that you work with or any internal accounting departments or software tools, those are not always set it and forget it pieces to the puzzle. So make sure you're reviewing that. And the reason we're doing this webinar now is because it's coming up on year end. It's always a great time to review sales tax, income tax, get that blueprint that we talked about in place, and make sure that everything is still up and running, even if you've done it before. And then the services to get those blueprints. The first two columns here we're going to talk a lot about today, so I'm going to skip over those. The third column is always, I say it's my favorite service to offer to our clients because it's a cashback refund, right? Making sure that you're not paying more sales tax than you need to when you make purchases. Make sure you're not over accruing use tax and giving it to the state, or making sure that you are accruing use tax and giving it to the state if you're making purchases and not paying sales tax on something taxable. So a lot of strategies there to make sure you're staying compliant, make sure you're not overpaying and getting some refunds if you are. And then the last column there, anything that's kind of in this catch-all, right? Exemption certificate management, property tax, credits and incentives. We've given other webinars about that. We're always happy to chat about them. So if any questions come up, if you've heard those phrases or terms used before, please reach out. We'd love to talk to you more about it. Credits and incentives is always big this time of the year too, because states are in their committees, they're coming up with how much is going to be in the budget to give out to businesses in the state. And a lot of times those need to be submitted January, February, and they might have a strict time deadline. So if you are expanding, picking a new site, hiring employees, I used to make a joke that if you're doing anything at all, you should be looking into a credits and incentive within your state, seeing if you can negotiate anything with your state legislators or Department of Revenue. Okay, Seth, I think I'm passing it over to you to talk about sales tax, main course here.
All right. Thank you, Brian. There are 45 states plus DC that actually assess sales tax or potentially require a company to collect sales tax. The ones that don't, we colloquially call the nomad states. Those are New Hampshire, Oregon, Montana, sort of Alaska, which I'll get into briefly, and Delaware. Alaska, it actually does not have a state level sales tax, but there are cities in Alaska with that do enact sales tax and do require collection. So if you sell goods into Alaska, you may still have a sales tax collection requirement. Historically, though, sales tax is only collected on tangible personal property. And that has evolved quite a bit over the years. There are states that tax on almost everything. New Mexico is a great example. It's their sales tax is really more of a pure gross receipts tax. But there are a few other states like Hawaii, South Dakota, and West Virginia where they essentially charge on everything. So no matter what service you have, what property you're selling, it's very likely going to be subject to sales tax. But there are plenty of services in other states. New York, for example, the services that are specifically enumerated by statute are also taxed. And that's true for pretty much all states other than the ones I just listed, like New Mexico, that generally charge on everything. And there are very common services that we see that are taxed. Could be information services, could be data processing, admissions or health clubs, landscaping services. Those are all good examples of services, and SAS is another great example and a very common one that we see companies have issues with. That just because you're selling a service doesn't mean, like software as a service, doesn't mean that the state doesn't tax it. And to make things a little more complicated, there are couple states like Colorado, for example, where the state might not tax it, but the city does. Chicago, Illinois is another example. So it's definitely very nuanced and complicated. And again, the progression historically has been from taxing only tangible personal property to taxing certain services, and certainly more popular services. The intention, though, is only to tax once. So if you're buying something and then reselling it, and you're selling it to the end user, you would only tax your end user. You wouldn't pay tax when you purchase it also. Very important caveat there is, while that's the intention, a state won't have any problem double assessing you. You know, you really have the burden, and the onus is on you to collect proper exemption certificates. So if you're buying something and you shouldn't be paying sales tax because you're reselling it, for example, you have to provide a resale certificate. The person you're buying it from has to keep it. So depending on where you fall out in kind of the chain of vendors versus purchasers, you really have to keep the exemption certificates in case you're audited. Because if you don't have them, even though technically the sales tax is only collected once, you're really at the auditor's mercy if you don't have it. Also, we're going to get into this a little bit more in future slides, but Public Law 86272, which some of you might be aware of, is a protection from net income tax liabilities. It does not protect you from sales tax. It's very common that we see our clients claim that they have 86272 protection, so they don't have to worry about tax in general, including sales tax. But that's just not the case. It's purely a net income tax exemption. And we'll definitely get into more of that later, but in no way protects you against sales tax.
Yeah.
Go ahead, Brian.
Well, no, I was just going to say, a couple points there. So you had said Colorado. We didn't say the city, but the city of Denver taxes the SAS there. And so those are some of the nuances where you say, okay, I've heard about sales tax, or I know that SAS is taxable, and there's these thresholds. Colorado doesn't tax it, and let's not worry about it. But really, you need to worry about the cities. Alaska's the same way, because the cities in these states can make their own taxability decisions. So that was one thing. The other thing it kind of cracks me up is that the states are getting creative with how they tax, SaaS and software and some of these other things, because they'll say, well, we are a state that only taxes tangible personal property. However, that SaaS or software that you're purchasing shows up on your computer screen, and therefore it's tangible because you can see, the results of it. And it's like, well, okay. So that's kind of funny. And of course, many states are operating at a deficit. So they're widening their tax base to say, how can we get more tax revenue in through our doors?
Yeah, that's a good point. States they want to tax everything. They want to collect revenue. So they'll try to bucket it into something that's taxable. So Texas is a great example. Texas very aggressively taxes data processing. So they'll try to bucket almost anything that touches a computer into their data processing. Even though if you read the data processing statute, it seems a bit antiquated, but their default is almost, we're going to tax it unless you can prove otherwise.
Yeah. And now Washington's the same way. For any of you practitioners following that, right? October 1st, 2025, Washington passed a pretty wide sweeping bill that's going to tax a lot more. So, okay, let's keep moving. And I hope you guys like my pictures that I fought fought for. I'm still staying on the Thanksgiving theme here, so feel free to weigh in. Do we like them? Do we not? What's your favorite dish? Go on, Seth.
Sure. So now we're going to talk a little bit about Nexus and just what it takes to actually be taxable. So you don't have to worry about whether you need to charge sales tax unless and until you actually have Nexus, you have a taxable presence in that jurisdiction. The things changed quite considerably and dramatically in July 2018 when the Wayfair decision, South Dakota versus Wayfair, was passed. Really, I mean, we could have a whole conversation on Wayfair, but really the gist of it was essentially to open up states to be able to collect sales tax, even if a company's only entrance to the state was economic. So just by the mere fact that that a company has customers in the states, and even if you never step foot in there physically, you could still have you could still have Nexus. You could still have a taxable presence in that state. Wayfair, the case actually involves South Dakota, and South Dakota at the time had a threshold of $100,000 or 200 or more transactions. So basically what that meant was if a company's gross receipts exceeded $100,000 or they had more than 200 or more transactions in the state, then South Dakota was going to require them to collect sales tax. A lot of states kind of modeled their statutes against this. Not all states have the same threshold. No state is lower than this, but some states are higher, like, for example, a $500,000 threshold that California has. And some states actually did away, and more states actually are doing away with the transaction threshold. So this economic threshold is really a way, and every state that has a sales tax, including DC, now has this. Actually, some of the Alaska cities also have this as well, where if you're crossing that threshold, you now have a taxable presence in that state. It doesn't mean your taxable presence starts on day one. You really have to look at the statute. There's definitely nuance to it, and it depends on the state. It could be that your taxable presence now starts in the next quarter, the next taxable year. It really depends on the state. But suffice to say, you may have Nexus, and it's very common for us to hear from our clients that, well, I sell through Amazon, or most of my sales are exempt. You know, I have $1 million of exempt sales and only $50,000 of non-exempt sales. Well, all sales may potentially count towards this threshold. So even though your non-exempt sales or your non-marketplace facilitator sales might be under that threshold, you still potentially have a tax collection responsibility. And it's very important to realize that and charge tax appropriately. Sourcing actually can be a complicated issue for sales tax. Generally speaking, the sales tax is assessed at the location of your customer. And your sales tax rate is actually, for most states, is going to depend on the specific site of your customer. So, for example, here in New York, Manhattan has a different rate than Nassau County. But the source generally is to where the location of your customer is. But for SaaS, that can be quite tricky. For software as a service, you might be selling licenses, and you might be selling licenses to a large company, and their users are all over the country, not necessarily just in one state, or not necessarily just in the state of the billing address. Conceptually, and we're going to get into this, it's a little similar to how you figure out where your income tax gets apportioned. But from a sales tax perspective, these are important rules to look at, both from a Nexus point of view and do I actually have to charge, and where do I have to charge sales tax? Meaning, is it all to one state, or do I need to divide it up if there's some multiple use? Just because every state has now enacted economic Nexus standards doesn't mean we can completely dismiss physical presence. it's still key, and you will have Nexus even if you just have a physical presence in the state. So you could have employees, you could have independent contractors, property, payroll. It doesn't necessarily have to be a direct, constant physical presence, but suffice to say, your physical entry into the state still matters, and you will have Nexus even at $1 if you have physical presence. You don't need to cross any economic thresholds.
Yeah, and that real world, real scary, I put in there because we have had clients that say, well, I don't own any property in the state, but I do have customers that rent it. Well, that's going to give you that physical presence there. So even if you're not over the 100,000 or 200 transactions, so that's something to keep an eye on. Delivery, maybe you have your own trucks that you're delivering your product in. If your own trucks are getting into that state, that's going to trip some Nexus, both for sales tax and income tax. We'll talk about that later. But these are just things to kind of keep your eye on. I will say I'll give the states credit about dropping the 200 transactions, right? So as Seth talked about that initial Wayfarer case, South Dakota said, if you're doing one or the other, you're going to be required to collect sales taxes and give it to us. And the idea essentially was to protect, the mom and pop stores who were just doing small business into the state. And, I've had clients that sell $10 products, but they'll sell 1,000 of them into the state. And so, not a ton of revenue there, but they easily cross that threshold. And so you're kind of putting this, what they call undue burden onto this taxpayer because they don't have the money to deal with all these different taxing jurisdictions and all of that. So it's awesome to see the states dropping that and keeping their rules applying to the bigger taxpayers. I was also wondering, Seth, this has been, we're coming up on, we're over 7 years of Wayfarer. So I wonder, anybody on the call that's like, yeah, I've heard this before, please let us know. But, there's always these asterisks and unique examples that apply to certain sales that people don't realize. So that was the main course and the side dish. Let's get into another question. Judy, if you're around still. Favorite Thanksgiving tradition? Go ahead, Judy.
Yeah. So second poll, favorite Thanksgiving tradition. Are you familiar with how using fulfillment by Amazon impacts your state and local tax nexus? We're going to launch the poll. You should see that on your screen. Give you a couple of seconds to put into your response. I love how the Macy's Day Parade one correlates to what is FBA? We actually had a question come in from one of the attendees asking to explain more on the sales tax of drop shipments to states that are different to the bill to the customer. So hopefully that's something we can.
Yeah, the drop shipment stuff can get real confusing, so I'm not surprised there's a question about that. We used to include it in this webinar, but it takes some time to explain. But the short answer to that question is, we use drop shipping to say, instead of having the drop shipper deliver it all the way to where I live, and then we'll turn around and deliver it to where the customer is, that manufacturer or provider of the product is just going to go straight to the customer. And so you're still saying, I'm the vendor on the sale. I need to collect sales tax to my customer wherever they are, if I have that nexus. If you don't have the nexus, you don't have the responsibility to collect the sales tax there, obviously. And then the question becomes, does the vendor have to collect exemption certificate, all of that. So we've got some pretty good diagrams we can share with the person that asked that. But that's the short answer.
Yeah. All right, and the poll has closed. Looks like about 47%, majority of the responses say no. They are not familiar with fulfillment by Amazon or FBA. All right.
Or maybe they just like football and naps, right? Seth, what was your favorite? What's your favorite tradition?
Football for sure.
Yeah, I might lose some participants here. I moved to Arizona from Kansas City, so my Chiefs are playing Thanksgiving and Christmas this year. So I'm excited to eat a lot and watch that on the couch after doing the dishes. Of course, I do my part. Okay, sales tax, the adult beverages. I put this in here because this is the things on this slide are a little bit more complicated, and so it's meant for adults or somebody who is well experienced in the sales tax or Nexus world. So retail delivery fees. This is something that came up. Colorado passed theirs first. I think that was in 2022. Minnesota has followed. New York and New York City have tried a couple times to get theirs passed, not yet. But the question here is this going to be a new trend that the states are all going to adapt, right? We talked about how are they going to get more revenue into their coffers. And this is one of the things that Colorado and Minnesota have done. As you can see there, it's just another fee that you need to collect from your customers if you're delivering a product on wheels. It doesn't matter if you own the truck or not. And so you can see the consternation of vendors that are saying, hey, do I need to put this as another line item on the invoice? How do I report it on my sales tax returns? Does my software enable me to collect this fee? Can I collect it from the customer? Is it out of my pocket? So all these questions have come up. Of course, there's some legal challenges of constitutionality. So we will see how this plays out. But as of right now, Colorado and Minnesota do require this. So if you are a business that sells into those states, or if you have a client that sells into those states, something you definitely want to look into, take care of, because the states will audit for this. I've seen that happen. And then keep in mind, I mentioned this earlier in the presentation, but sales tax is always changing. It is not a set it and forget it situation. The last couple of years, you can see there, Minnesota has eliminated their tax. Kentucky, Maryland, and Louisiana have started taxing SaaS. There are 13,000 taxing jurisdictions, so they are all able to change their tax rate quarterly, and so it's constantly changing. We did talk about the removal of the transaction count thresholds. I love to see it. It does make it simpler for a lot of those smaller businesses. The taxing of the B2C versus business purpose. With some of these states and how they tax SaaS, again, a lot of asterisks, right? If you are selling to certain states, they will say, well, we only tax SaaS if you're selling to a business. Some will say the complete opposite. We only tax SaaS if you're selling to the end user, Brian S. So a common example of this would say Salesforce, which I think a lot of people are familiar with. That's a SaaS product. Do we need to charge it because it's to an end user or to our business? It depends on the state. So again, these adult conversations, difficult conversations to make sure that you're taken care of. And then FBA, right? We alluded to that in the last polling question. It does not create a physical presence in Pennsylvania. Pennsylvania has come out and said, hey, we're not going to require businesses that only have Nexus because of FBA. However, California has come out and said, yeah, absolutely it does. And a lot of the other states have kind of been silent on the matter, but they are enforcing it. They might not have had a published statute or court case or regulation, but they have been enforcing it. So this is huge, right? Especially if we all know how big Amazon is. Prime deals start today, by the way, guys, I think. So if you're a Prime member, but we have a lot of clients that say, well, I sell jewelry or I sell house products, whatever the case may be. I don't have a warehouse in the state that I'm located, or I don't have a warehouse across the country, and I just operate in my one state and I sell it all through Amazon. That could potentially be problematic, especially if your sales are high, because then you're gonna have a lot of liability. So if you have product stored in a warehouse in California or any of these other states, now you have a physical presence there, right? Because they're saying you own that property, it sits in the state, and therefore any of the sales that you make to Seth or Brian when he buys your jewelry or house product, that's going to be required to worry about sales and income tax. The question that you guys should be asking is, isn't Amazon responsible for collecting that sales tax? The answer is yes. But again, if you have your own website and you only sell, to Seth's example, $50,000 worth of product outside of Amazon, Now they're going to say, well, you have a physical presence there, and so you have to collect on that 50,000. So something to keep in mind. I do think we talk about this coming up in the income tax slides, but of course, that gives you a physical presence for income tax as well. So tricky parts there. Favorite adult beverage, Seth, if you partake?
I got to think about that, actually. I wasn't expecting that question.
Okay. Yeah, you weren't. I told you I was going to throw some random questions there.
Anything works, though.
Okay. All right. I'm a big, just a standard beer or margarita. So anybody who's in the Arizona area, let me know. I'll buy you one. Okay. So we've kind of gone through sales tax, the main dish, the side dish, the dessert, the adult beverages rather. So now that you have all this, what's the game plan, right? You need to take the next step. And so we have this little 3-step or 3-phase approach, whichever your favorite word is. And kudos to our team here. We have a little bit more rhyming or alliteration here. So identification, rectification, and collection. I think those rhymes. Haven't taken an English class in a while, but so that's what we're going to do here. So first one's first, do the Nexus study. This is important because it's going to give you that blueprint of where do we have Nexus? And again, Nexus is just legal jargon. Darn those lawyers, Seth, right? The two of us that come up with these legal jargon words. It's just legal jargon for connection, right? And so this, as Seth said, you can't, the state can't enforce their tax laws on you unless you have this connection, unless you have this Nexus with their state. So do this study to figure out where you have that connection, where you have the Nexus. Figure out if what you're selling is actually taxable. Is it taxable? Is it non-taxable? Is it exempt? Those are different things, and different states have different rules on it, right? So if you are selling a widget that someone else is going to turn around and resell, that would be an exempt sale, exempt for resale. So some states might say, yeah, we include that in our threshold. So all the other stuff that you do sell that's not exempt, you need to collect sales tax on it, as opposed to a non-taxable service, let's say. So, accounting fees or something like that wouldn't go towards, and that's an extreme example, but you get my point. That's a non-taxable thing. You don't need to worry about it in most states. And then figure out what your outstanding liability is. And this is huge. A lot of people say, yes, I have Nexus in these 10 states. I need to register. I need to get straightened out there. Pause and figure out how much outstanding liability you do before you go into that registrations. And this leads us over to that second column here. If you have minimum outstanding liability, sure, go ahead and register, get compliant. If you have a large outstanding liability, this is where these VDAs come into place. I put 5 benefits on there, quickly running through them. Anonymity, which is a fun word. A lot of the states will allow your SALT professional to submit a request for voluntary disclosure anonymously. It limits the look back. So if you've been using, let's say, fulfillment by Amazon for 7 years, this look back will only go 3 to 4 years typically, depending on the state. So that can be really powerful, save you lots of money. It lowers the interest. It eliminates penalties altogether. That can be huge, especially in a state like Washington that has a 39% penalty tax. So it gets rid of that altogether. And then the 5th one there, it doesn't always get talked about because it doesn't show up on the numbers or in the spreadsheets of how much you're saving. But it's one of the biggest benefits to a VDA, which is it's a taxpayer-driven process. We are going to say to the state, here's what we owe you. My bad. Let's go forward hand in hand, and the state wins because they get some tax money, and you're going to start collecting taxes there. You win because you save yourself money and a headache, as opposed to waiting for an auditor to come in and really dig through your books, and you're assigning a team member to deal with all their questions and all of that. So really powerful there. Registrations, by the way, will be done through a VDA process. So I know I get that question a lot. Well, we got to do a VDA, then we got to do a registration. No, it's kind of all combined there. And then once you do either the registration of the VDA, you can do the ongoing compliance. So collect sales tax where you are registered, and then file your returns. Typically, they're going to be monthly or quarterly. And so, this is a little bit of a headache to go. Like I understand it's a tough pill to swallow because you're doing this work to figure out where do I need to do more work and collect taxes. But once it's set up, I promise it should run pretty seamlessly in the background. It is a pass-through tax, so it won't be coming out of your bottom line. So get it up and running. The sooner the better. And I think we have a case study here. And so this is a client that we had that's just e-retail, right? This happens a lot now. Like we said, a lot of people are selling over the internet or through Amazon. Customer or client rather had $25 million of sales, and there's any reason to do a Nexus study. One of those reasons that should be on here is year end, right? You've figured out, hey, what did we sell into all the states this year? You're already putting together sourcing and apportionment files for your CPA or for your internal team. And so review how much sales you had in these states. But growth, we've had a lot of clients that say you can have explosive growth through online sales, obviously, or you might have a change of accounting personnel. We've had clients that said, yeah, the old CFO, he's been here for 50 years. Maybe he doesn't have a pulse on the sales tax laws, and so you have someone else that's very aware of this. Or prepping for due diligence. We talked about that earlier. This will always come up. So we put the date signed and date delivered there just to say this should be a fairly quick process to review, put analysis together to see how much outstanding liability you have, cover all the states. Even if you don't think you're selling into these states or you have personnel there, we're good. Do a study in all the states and get yourself that full blueprint. And with this particular one, we ended up doing 6 VDAs and saved the client $168,000. So that's savings and penalties and look back, lowered interest, all of that. So super powerful. Okay, I think we're ready for the third. I think we're on 3. There we go. Judy.
Thank you. All right, so this will be the third of the 5 polling questions that we have. Question is, will you be prepping the turkey next week? Or are you familiar with Public Law 86-272? So it's yes, I'm a pro, or no, thank goodness. Go ahead and lock in your responses to this poll. It's on flip-flopping, so I don't know if someone's like unsure what Public Law 86-272
Yeah, let's
is.
answer the question in the parentheses, but have some fun with the other one. I know my answer, Seth. What, Judy? Go ahead.
I was going to say, for me, I'm not prepping turkey. I'm actually going out to have dinner.
So you are?
I'm relieved of those duties every year. Actually, no one would ever want me to cook a turkey, to be honest. That's not my strong suit.
I like to stand around and look busy and give compliments to the baker. Hold the knife in my hand. So if anybody looks over, they'll be like, "Oh yeah, Brian's helping," but no, I'm doing nothing.
Mm-hmm.
Seth, what about you?
I'm ashamed to admit it, but I actually don't even know. Could be my wife. Could be someone else.
Yeah, you're in for a rude awakening in a couple days, huh?
Yeah.
So it looks like majority of the responses said no.
Okay.
Right. Well, it's actually a good thing because we're gonna talk more about it and some of the changes as well. Now getting into income tax, kind of our main course. Every state except South Dakota and Wyoming have some sort of business tax, income tax, whatever you want, gross receipts tax, really whatever you want to call it. It's some sort of tax based on your income. Even Nevada has, Texas, Florida, the states you generally don't think have tax, still have it. It's really just South Dakota and Wyoming. Just like sales tax, you have to first determine whether you have Nexus, where you have that taxable presence in the state. And similar to sales tax, you either have it economically or physically. There are a couple actual ways where you can establish Nexus economically. Some states have what we call factor-based presence thresholds, like California, which is now 757,000 for sales, 75 for payroll, 75 for property. Connecticut and Alabama have their own factor presence thresholds, meaning set limits that you have to cross in order to be considered taxable in the state. But the Multi-State Tax Commission, it's kind of a quasi-governmental agency that provides guidance to states on how to administer tax rules and how to enact different tax rules. And we're actually going to talk about them a little more soon in the context of 86-272. But they have their own threshold set up. So despite these thresholds, many states actually don't have their own thresholds that were enacted legislatively. It's just if you have clients in the state, if they're substantial enough, whatever that means, and that's very uncertain, you might have nexus, economic nexus in the state. And again, you could still have physical presence in the state. It doesn't have to be direct, like an office or employees. It could be indirect. It could be what we call click-through nexus. So you're getting a commission from someone clicking on your link on another website. There could be affiliate nexus. There are other ways where you can establish nexus in a state, but it's easy. I think the key here is it is extremely easy to establish nexus. And from a practical perspective, once a state says you do have nexus, it's almost impossible to say you don't. There's a constitutional standard to nexus, so there's not much you can do other than litigate for who knows how long, which is probably not the best advice. So again, it's just generally, are you doing business in the state? Public Law 86-272 is actually a very important consideration. Essentially what it is if all you're doing in a state is soliciting sales of tangible personal property, and the sales are shipped and approved from outside the state, and delivered by common carrier, which is another key factor, then you're not subject to net income tax in that state. Again, this doesn't cover gross receipts taxes. It doesn't cover sales and use. It's just net income tax. But it doesn't mean you don't have to file. It's not a nexus protection. It's really just a net income tax protection. And again, as we're going to see, this law was enacted in 1959, and it can only be overturned by the Supreme Court or Congress. But we're going to talk about it on future slides that states are chipping away at this, and the protections, you need to think very seriously about the activities you do in each state. Are they potentially outside the scope? And are you doing anything that may call that into question and create a risk for you? So it's a very, I think it's a much more in-depth and serious consideration now than we had just a few years ago, because of how states are kind of chipping away at these protections.
Yeah. Thanks, Seth. And I was going to say, to your point, the doing business and deriving income is designed so that the states can enforce their laws if they would like to. Now, there's always a practical decision to make as a CPA or as a business to say, well, okay, we have, $10,000 worth of sales into the state, and the state has a deriving income nexus law. And we might owe zero taxes because of our cost of goods and all of that. So the decision is one that a business sometimes says, well, I think we're probably good there. So can't legally advise you to do that, but I understand that thought process. And it's a good segue to a question that we had. Graham, thank you for the question, that said, if we are having over $100,000 worth of sales, but all of our sales are via resale on the sales tax side, do we still need to register and file the zero income returns there? And the answer is, depends on the state, and that's always the solid answer for a salt professional. But a lot of states, Graham, technically say yes. Some will say no. So you kind of have to look into those rules. Now, again, the tax risk there is pretty low. But again, if you're ever looking to sell the business or anything like that, you might want to consider it. And a lot of times, if you have zero tax due, you can file an annual return. And so that return will be pretty simple. And so sometimes to say, hey, let's just cross our T's, dot our I's, and take care of that. Let's keep moving here, Seth. I know we're coming up on time before long, so maybe we'll move a little bit quicker through this stuff.
Yeah, sure.
Seth and I like to talk tax law, as you can tell. So we're anybody who wants to talk more about it, give us a ring.
Just because you have Nexus doesn't mean you're taxable in the state. You determine your taxability through sourcing. And to Brian's point about, just a little bit of sales, I think personally, you really have to look at Nexus very conservatively. And from a practical point of view, sourcing is really where you want to make your business decisions in terms of what income do I have is actually sourced to the state. And that's going to vary depending on what the company does. Are they selling tangible personal property, or are they selling a service? Tangible personal property generally is going to be sourced based on the location to which it's delivered. Whereas services, there are two general methodologies. It's either going to be cost of performance, which is essentially where am I doing the work to earn this revenue, or market-based, which is where is my client located. Just kind of anecdotally, most states now use market-based sourcing, but 39 states, and about 40 states now use what's called a single sales factor. So how you source the tangible personal property versus how you source a service, that's how you source your receipts. States can also potentially use your payroll and property, what we call a three-factor formula, to determine what your overall percentage is. And basically, in a nutshell, what apportionment is, it's just the ratio to which your federal income tax, your federal net income is taxed in the state. So let's say 20% of your customers are in California. California, as a single sales factor state that also uses market-based sourcing, 20% of your apportionment is in California, and now 20% of your net income is now taxed in California. Some key considerations here are the throwback or throw out rules. And there's a lot of nuance to it, but it's very important to consider, particularly for companies that sell tangible personal property. So again, kind of picking on California just because it's easy and aggressive and a high tax state. If you ship all your goods out of California and you don't file in any other state, maybe you're 86-272 protected, or you just forgot, or whatever the reason is, California actually requires you to throw back all of those sales. So effectively, you have 100% California sales factor now. So you're taxed on all of your federal net income in California. So you've kind of ruined any 86-272 exemption you have. So they're very serious items to consider, the throwback and throw out rules, not just from a risk perspective, but from a planning perspective. Can you do anything to overcome it, whether finding another warehouse to ship out of, whatever the case may be, can you actually plan around that?
And we could talk, a whole hour on just the slide. The thing to keep in mind here is, as the year is ending, if we have any tax preparers on the call, or if we have any business owners on the call, it's not always as simple as saying, hey, this is where I delivered it, this is where I need to file income tax returns, or this is where the work was done. So take into account these rules and figure out what they are. Seth and I's job at some of our previous firms was always to quickly push pause before our income tax team actually filed the returns, because sometimes the numbers needed to be worked on a little bit. Okay, let's keep flying through this. Here's the side dish on the income tax side, which is the business taxes, as I call them. there are several states too that have some sort of business tax, whether that's a gross receipts tax, you know, you have Nevada commerce tax, Ohio CAT tax, Washington B&O tax, Texas franchise tax, so all these things that also need to be considered in addition to sales tax and income tax. If you are doing a voluntary disclosure in Washington, keep in mind that you're not only going to have to pay the sales tax in Washington, but you'll have to pay B&O tax. So factor that into your budgeting, all of that. Again, as we've talked about, this is not protected by 86-272 since it's not an income tax. And as I said there, make sure to account for it in your reviews. Want to make sure that we get to the polling questions in case anybody missed one. There we go.
All right, next polling question. I put up my tree, Kinara. And question is, I have reviewed my Nexus or my client's Nexus. So we've got
when have you done it last, or how often have you done it? Talked to a lot of clients and businesses that said, oh, you know, we did a Nexus study 3 years ago. We're good. I would argue that that might not be the case. But I will say, Judy, in my house, I fight. As you can tell, I'm a big Thanksgiving fan. I want to give it its due. So I try to fight putting up the tree as long as I can. My wife is downstairs, you know, itching. She's like, I got to put it up, got to put up all the ornaments. So
you celebrate all the holidays. I appreciate that. All right, we're going to end the poll in 3, 2, 1. Looks like it's pretty split between last 12 months, couple few years back.
Okay, good. Yeah, like I said, we have a lot of clients that think they've done it once and don't do it again. So make sure to review this as your year end comes around. You might have new locations that you're selling to. You might have a remote employee that you've hired somewhere. You might be doing FBA now. So things change, right? Things change quickly. Seth, we talked about this. I don't know, just quickly fly through it maybe so we can get to the end.
Yeah. Really, to sum this up very quickly, is public law 86-272 protections are going away. There are certain states that have actually carved out exceptions, but suffice to say, if you're doing anything on the internet, it's going to be very hard to get protection. I think the future for public law 86-272 is questionable and could go the way that just like economic nexus is now a thing for sales tax, public law 86-272 could be gone before we know it, because you know anything you do on the internet now these days is pretty much takes you out of protection. So if you've claimed 86-272 protection, you should talk to us.
Yeah. This last slide here. Yeah, I was just going to say it's the same as kind of before. Just to prove the point that you can also do VDAs with the income tax. So Seth, I don't know if there's anything else you wanted to touch on.
No, that was
keep it moving.
Synopsis.
And this was a quick Nexus study, or excuse me, case study for an income tax where we had a client in North Carolina, and North Carolina doesn't have a throwback rule and they're a market-based sourcing rule. And so you might be able to minimize that top revenue line item on your tax return to take advantage of some of these laws, especially as Seth referenced, you know, in a state, if you're located in California, any way that we can move that to a lower tax state, that would be fantastic, especially if you're a bigger business. And with this final polling question, and then we'll be done after one more slide. Judy, you want to send this through?
Yep. All right, as a reminder, this is the 5th and final polling question. Best Thanksgiving dessert. Have you had an income or business tax sourcing or Nexus study alongside your sales tax review?
Yeah. Have you done both?
Submit your responses there, yes or no. I'm a both. I love desserts. So.
Okay. Yeah, you can't really go wrong on this question. On the dessert side, you can't go wrong if you're not doing the income and sales tax nexus, which we usually see separated out, and we'd love to see businesses start doing both.
Precisely. All right, and we're going to close the poll in 3, 2, and 1. All right, so that concludes all the polls. And
Yeah.
I guess before closing today's webinar, obviously, please be informed that if you have submitted any questions that have not been answered or responded to yet, we will definitely respond to you directly after the webinar has wrapped. Again, we're incredibly grateful to Brian S. and Seth Rabe for their contributions to this webinar, and a special thanks to our webinar attendees for your participation. If you'd like to schedule a call with our experts, go ahead and scan that QR code on the screen or from the presentation handouts. We hope to see you at a future Layton Learning event. Don't forget to check out our website, www.layton.com/US, for our upcoming webinars. Have an amazing day and
Holiday.
happy Thanksgiving.
Thank you, everyone.
Thanks, everybody.